Okay, good morning, everybody. Welcome to today's session on real estate property technical services from the Latino Chamber of Commerce. We appreciate your participation. This has been a series of webinars, all related to commercial properties, and it's been a good journey. It's been a few months. And I think this would actually be the last topic for this year. Our friend Luis Olvera is the person who is being presenting the information, and the whole idea of webinars or of the series is to make sure that any business owner that is considering or planning to buy a warehouse, to buy his own office, to buy or even rent a location to run his or her operations on, that these people have a pretty good idea and it's got all the homework done before going into the process of doing the buying or the leasing. Because it's not such an easy process. There's so many variables, and Luis have been very helpful in giving us the high level ideas on exactly what we need to know. So this is great information. It's not really ready, it's not available everywhere. So we're just partnering here with Luis and the Latino Chamber so we can provide this service to you with this series. But with that, I just wanted to introduce you to Luis and read a little bit of his background, his credentials. He has a lot of experience and expertise on commercial real estate. He's a Minnesota. Let's see. He's an agent. He's a Minnesota residential and commercial real estate agent, and he's been active for over 15 years. And in the past, he's been a director of membership at the National Hispanic Real Estate Professionals Twin Cities chapter, and NAREP. So he's been working with them for a while in the past. Luis has over 18 years of experience in international business, contracts, negotiations, development, and subsidiaries, exports, imports. I know he's got a lot of certifications and licenses to be able to present real estate in terms of commercial real estate. So I can keep talking about all his credentials, but I don't want to do that. I'm going to let him start his presentation so everybody can get today's information as soon as possible. So Luis, thank you very much for being with us. And just, hey, here's your time.
Thank you very much, Fabio. As always, it's a pleasure and honor to be able to share, as you perfectly describe, a high-level information, general information of now we have, with this one, 19 webinars, 10 in Spanish and 11 in English, 9 and 10 in English, with really a lot of commercial topics, all of them, from how to invest, to rent, to buy a warehouse, to buy a restaurant, etc. And again, it's just the minimum information, if you will, so your members and the general public is aware of what elements exist, what mechanisms I can take, which people I have to hire in order to have a successful transaction in commercial real estate. So with that in mind, let's tackle our topic today is how to minimize the tax burden when you are selling. Now we're going to go to the other side of the spectrum. We're going to sell commercial real estate, okay? So let's tackle the first approach. What is the first thing that anybody has to do? As the proverb says, no? Everything starts with a deep desire. Once that is a continuation of investment, okay? You do not as we saw in the last transparency, you do not cash out or take out cash from things. It's the same. Okay? We continue the story or the history. And before 1991, this is a very interesting situation. In 1986, a guy by the name of T.J. Starker swapped a lot of his land for land, because that was the name of the game. And it was his old land. Obviously, he was the owner for years and years, for a new land, because he didn't have a new land, obviously, no? And in that time, he went up to the Supreme Court because it was the situation of the deferral. Okay, so that's when we started to go to the deferral mode. And in 84, another big change happened in the IRS code, which was or is the exclusion of partnerships and LLC. The IRS consider an LLC and partnership as membership interest. Therefore, is a security or personal property and does not qualify. Okay, so be very, very careful when you are going to make a 1031 exchange. There is a very interesting mechanism by which you can go around this mandate, meaning that if you have an LLC with your friends or your family, you dissolve that, you sell, and then you form it again. Oops, what a nice way to do it, no? So that is basically a little bit of history about the deferral and the deferral of the tax and time to be able to buy a new property, okay? As we are going to see here, you have to include, in 1991, it was a big change also, the inclusion of a qualified intermediary. What is a qualified intermediary? And we're going to see this and in more detail. He's a neutral party. He comes to the closing. He takes the money. He is not an advisor or attorney or agent. He is just acting as a principal for tax purposes. Okay? Very, very interesting thing here that could happen. And we're going to see, because in 1031 exchange, you have up to 180 days to make the exchange. The money can be seated in a drawer or in a bank, or guess what? Producing interest. So who is going to be the owner of those interests? And what about if that money goes to stocks and the stock value? Careful, careful, careful where the qualified intermediary puts your money. And obviously you are one of the signature holder that can take the funds with the intermediary, of course. The intermediary has to sign because he ultimately at closing of the next property that you are buying, he's going to release the funds with your signature, okay? So be very careful, and obviously, needless to say, you have to hire a mega reputable qualified intermediary that has been 20 years in the market at least. I will not go with Peter Smith that is in the corner. And he says that he is a qualified intermediary because the next day of closing, your money and this guy is gone. Okay, so now let's go a little deeper in the rabbit hole and see what the IRS says. This is really kind of a copy-paste of the statute and the code, excuse me. And by the way, parenthesis very quickly, do you know what is the difference between code and law? Well, a code is a compilation of laws, while a law refers to the rules and statutes that govern society. Okay? A code is a collection of laws that affect in jurisdiction and includes also case law and enacted laws. The codes can be organized by subject matter and include amendments of the existing laws. Very interesting. A law is what really governs a community, protects the safety, and ensures citizen rights. A law also can be verbal or can be written. Very interesting, huh? So this is what the code, now we know what is a code, says in this section 1031. Basically, that no gain is recognized by the IRS if when you exchange the property for a productive use, not for joy and enjoyment, okay, use in a trade or business for investment, very important part of the definition here. And such property is exchanged for like kind. We are going to see all these elements in depth, what exactly that means in familiar words, okay? The next slide says more in depth about the element of the definition. Number one, this is a federal, but also covers the tax code. Why? Because, as I mentioned before, if you are in Minnesota, you have to pay 8.5, 7.5. If you are in California, 13.5 state tax. But if you are going to do a 1031, guess what? You do not have to pay a penny for tax in the state or state tax. So that is why it's a federal, the 20% plus whatever the state demands of sales tax. You are deferring paying the capital gains. And we saw in the example of the 700,000, you are not going to pay a penny of that 700,000, okay? But you have to dispose your old property, and you must have to acquire a like-kind property. We're going to see what is a like-kind property. And also, super important, it is for investment or business use. Therefore, you have two situations here. The house or the property in which you live and you sell after 10 years and you make $200,000 and you are married, well, because that is your single family home in which you lived for such a long time, then another very different treatment goes in the law and you are tax-free. And you can buy whatever you want. But therefore, that does not qualify for 1031 exchange. However, if you have multifamily in addition to your home, that multifamily is for investment, is for business use. That multifamily qualifies for the 1031 exchange. You see the difference? One is for your personal use, not business use. The other one is for investment or business use, okay? Let's go a little deeper in the rules and requirements. Equal or greater value. It cannot exceed the double of the value of the exchange property. Let's keep in mind our example, no? Do you remember we sold it for $1 million? And by the way, very interesting thing here. You can include in the $1 million of sales price or purchase price the commissions paid by the seller, which is you. You can increase that value by the commissions if you pay them. If you don't pay them, you don't include them, obviously. Okay? And you cannot buy anything more than $2 million. Okay? If you are going to make a 1031 exchange. Everything is related to 1031 exchange right now. What is the 95.5% rule? Well, imagine that there you're going to buy an array or properties that are under umbrella, and those properties are 10. To make a very easy example, there are 10 properties here, okay? And each of those properties in that umbrella of a company are at $5 million. Well, the most you can buy is 2 million, no? So the 95% rule means that you can only buy 95% of those properties that are in the market. If that 95% in this example does not exceed of $2 million. Okay? If that exceeds, then you buy a little less, and then you buy another one. You can buy 2 properties, you can buy 3 properties. If the sum of the 3 properties do not exceed, in our example, of $2 million. Okay? Has to be an exchange. We talked already. You have to relinquish your old property and you have to acquire a new property, new for you, even though it has been in the market for 10 years or age for 10 years, was built in 2001, to say something. Here is when it gets a little complicated or more complicated. We're going to really, really dig deep into the rabbit hole. One of the many rules of the exchange says that you have 45 days to identify another property, and with a total, very good word, total of 180 days to buy. We're going to see that in detail. The like kind we talk about is business or investment, and the 3 property rule we kind of touch. You can identify up to 3. You cannot go to the closing and say, hey, you know, I think I want to have a 1031 exchange. No, that doesn't go like that. Or when there is the day number 44, you cannot dump the MLS, list 17 properties, and those are my identified properties. No, you cannot do those 2 things. You have to have identified 2 or 3 properties, that's the rule, that add up to $2 million in our example, up to 45 days. Advice: when you get together for the first time with your commercial real estate agent and decide to sell, guess what you do in parallel? You start to look for properties to buy. That is the best time to do it, not at closing, because believe me, in 45 days, you're not going to find a property that you like, that makes sense, that the numbers make a good profit for you, cash on cash, etc., etc. We talk all of these beautiful things in one of the webinars, the cap rate, all of those things. No, you're not going to be able to do. And if you don't, guess what? Kiss goodbye your 1031 exchange. So be very, very careful with these 45 days. Types of properties. You can have any asset class. You don't have to acquire what you sold. And we're going to see that more in detail. For instance, you have a multifamily, you can buy a farm. You have a car wash, you can buy a school. You have a gym, you can buy a movie theater. You can do those kind of things as long as it is real estate. You cannot buy, for instance, furniture or things like that. You, investor, because you are an investor, have the full control of what you are acquiring. You are the manager, you do your due diligence before buying, obviously. Very important, the due diligence. We have a complete webinar in this topic. You have to have all the different checks, point checked, because you are in full control of your new property. Okay, there's a long, long list that we have also have another webinar, how to buy real estate, and we went in detail of how to buy when you are the only owner of that estate. You have to be active in the investment, obviously, in the management, and a very sweet deal here is the triple N. I'm going to you what would be for me, obviously, everybody's different, a sweet deal for me. I have a multifamily 7-unit. I make a profit of 700,000. That's beautiful. It's free and clear. So I'm going to invest the 1 million in the same example. And what I would buy, you know what, in 1031 would be a warehouse that has 1,000,008, 2 million value in the market or purchase price. And guess what? That warehouse has a triple N. And it's going to be expiring in 20 days, or 20 years. I mean, or 3 years, you know. So that would be a sweet deal. These are the properties you can swap or defer or make 1031 exchange. Restaurant, multifamilies, empty warehouse, full warehouse, farm, car wash. I would like to have that car, by the way. This is a qualified intermediary. We talked a little bit about that. He is not going to put your money in escrow. Very careful where your money goes. He's not an agent, but he is the one that prepares all the documents, okay? This is the 45 and 180. The 180 days are from the day 0, which is closing, okay? That day 45, 12 midnight, you have to have 2 or 3 or 1 property identified that adds to maximum the double of what you bought. What are the exceptions? Well, that you identified your property, and guess what? The Katrina, Helene, all came and destroyed the property, or an act of God, or came another pandemic, another COVID, and you cannot buy it. Then you immediately ask the qualified intermediary to write to the IRS, to write to the title company, to write to the banker, to write to everybody. We are not going to be able to close in day 180, and I will have to have an extension to identify another property. Very, very careful with the days. Is if the financial exchange between two parties of a pre-existing relationship becomes, you have to fill up the form 8824, okay? By the A180 maximum, you have to close for your new property, okay? Let's very quickly do 3 examples. You can do, we're kind of running out of time. We have a lot of material to go, but this is, the first one is already what we talk about, okay? You sell the property for 1 million, you have 400 of mortgage. That's very important in mortgage. So you sell for 1 million and you had 400 in mortgage. You use the sales proceeds, obviously, for 400 because you're going to receive 1 million, correct? Therefore, you have 600 in cash. The 400 went to the bank. Then your purchase replacement property of 1 million, very simple example, has to have at least 600,000 in mortgage, okay? Excuse me, I'm sorry, 400,000 in mortgage. You can put additional money to diminish the mortgage of the property acquired, okay? And you can have the second property with $400,000 of mortgage as well. Okay, here is example, 1 million minus 600, well, 400 in new mortgage, which is okay, but you can put money from your sale, from your uncle as a gift to diminish the 400,000 for the new property. The other ones are when you are having a gain, like let's do the number 2 very quickly. The taxpayer sells the relinquished, meaning your property for 500, and you have only 100 in mortgage. Your replacement property is 500, but you obtain $200 of mortgage. The excess of mortgage, you are going to have proceeds of 100,000. That is recognized as a gain for the IRS purpose, and that is called a boot. Okay. Let's go to another exchange, and this is the 1033. This is when the federal government is nice, excuse me, nice, you or to you, and it is called a forced conversion. What is a forced conversion? Very simple. Is when the property is condemned, or now with Katrina, Helene, and Milton, it's destroyed by natural disaster, or seize through eminent domain. Let's say that you have a farm and the government comes and says, you know what, Mr. Smith, I want to build or to construct a highway, so I'm going to take from you 50 acres, but I'm going to pay them because nothing is for free here. Well, if you make a gain, are you going to pay taxes? If you don't go for 1033, yes, you are going to pay taxes, and it's going to be 35%. But if you do a 1033, you pay 0 taxes for that. Isn't that sweet? What a nice guys, no? But they give you money and you don't pay tax. You have to defer the taxes in 1033 exchange, okay? And it's always, I mean, this is no-brainer, that the cash received is greater than the market value and the difference is a gain, okay? The original property, continuing with 1033, is not as converted property and has to be, as I said, condemned, seized, or destroyed. The replacement property title of the converted property must both indicate the same individual or ownership. If you have a house in Florida right now at your name, you cannot buy another house in Minnesota at the name of your wife or at the name of Peter Smith, okay? It has to be the same. If it's husband and wife, the title owners, or the owner of the title, yes, you can do that like that. There are specific rules if there is marriage as well. In any statement kind of what I said, guys and girls, please, 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 if you're going to do it, talk to your lawyer, talk to your accountant, talk to your tax guy, and talk to the title company. Those are the experts that can give you detail. And believe me, any and every transaction is different. I'm just giving you here a high level information from the top, so to speak. In difference of the 1033 exchange, remember in difference of the 1031 exchange, the 1033 exchange has to be similar or related. For example, an apartment complex must be replaced with another apartment complex. You cannot swap for a car wash, okay? Very simple. This is very interesting way to look at the differences. This is more relaxed, the 1033. Why? Because you have up to 4 years in some cases to identify the other property. It doesn't have to be in the same state because this is federal, applies to any part of the country, okay? You can read it at your pleasure, and you can have the transparencies, obviously, anytime, any place. Now we're going to talk a little bit different gear, and we're going to talk to the Delaware Statutory Trust, or DST. In 1031, remember, you are going to buy or acquire the whole property. You are going to be managing, you are going to make the due diligence, you are going to make all the inspections, etc., etc., etc. In a DST, is fractional, which means that you are going to buy part of a large complex, large multifamily of 400 apartments, or a ranch of 250,000 acres, or mineral rights for a mine that is producing 25 tons a day of silver. Yeah, good luck, etc., etc. So you are going to buy a fractional part of that unbelievable big real estate, okay? Therefore, you have to have certain different rules. The DST itself has a limited liability. They did already the due diligence for you, and these are the advantages, okay? This is an institutional quality and very well professionally managed. There is normally, I mean, if you are going to be a part of a 450 apartment building or complex, believe me, it's going to be very well managed. and you are welcome to visit it. And it is a good idea to do this. Why? Because you are going to be allowed for the diversification. You can go to the DST and says, okay, sponsor, because they are called sponsors, the one that are the owner. You know what? I want this portion of my proceeds in this building and in that school and in that other warehouse. You can do that. Allows for this diversification. And guess what is the beauty of DST? That you go to Australia to fish and you will receive your check every month, every trimester, or every year, depending upon the status of the DST in particular. You don't have any liability for the property. Is the property and the organization, legal entity that is responsible for that. And needless to say, if the property is worth 10 million and you invested 1 million, well, you are going to have 10% of the proceeds or the profits. They did the due diligence, and is, as we say, mailbox money. You receive the check every quarter, every semester, trimester, or annually. They are going to give you a prospectus kind of thing, so you can study the ins and the outs of the property or complex, and you decide. What are the disadvantages? Well, in some cases of a DST, the statute says that you will not be able to take 1 penny out for 5 years or even 10 years. Okay, so you put $1 million and you sit down in Australia waiting for your return on investment or proceeds for 5 to 10 years. You don't receive 1 penny in that period of time. You have no control over management because obviously the management is there in the other entity. You are in Australia fishing. You cannot borrow against that interest or pull out your equity if it is by statute that you have to seed your money for 2 years, 10 years, or 3 years, whatever. You cannot take 1 penny out. Whereas in 1031, you just turn around and sell your building the next day, no? And you have accredited investors, meaning that you have to be qualified to invest in a DST. What is an accredited investor? Well, according to the SEC, this is a person that has a net worth of $1 million in addition to his house, or makes $200,000 in the last 2 years. I mean, every year for 2 years, $200,000. That is an accredited or a qualified investor. So don't think that Joe Blow comes with $300 to invest in a DST. No, minimum is $50,000 that you have to invest according to the DST. Some of them, the minimum is $250,000, etc. And of course, because they did all the due diligence, they have the management, etc. When you put your $100,000 an investment, guess what? You immediately get diluted. Why? Because you are going to pay fees for that. For that management, etc., etc., etc. Okay. No refinance is allowed. The DST is not going to refinance you. This is the market of the DST very, very quickly. We are kind of running out of time, but still we're good. This is 1.2 billion just in multifamily. There are only 50 sponsors in DST, and this is the how the DST in the United States is broken. The majority, obviously, is multifamily, second place industrial, and third place offices. That, oops, here again, you are running the risk of losing money there, careful. This is not win, 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 win. You can lose money in DST as you can lose money in your next building if you are 1031. I mean, life is not certain, okay? But this is basically the pie, the breaking down of the DST in the United States as of April of this year, okay? Let's see one advertisement, as I commented, is large large investment. In this case, is $27 million. The minimum is $100,000. Loan to value is 41, and the current cash flow is 4.5. This is how it is advertised. Again, you can sell in Minnesota and buy a DST in Florida or in Hawaii, doesn't matter. Let's talk very quickly about the 721. We have only 2 topics to go. 721 is kind of the same as the DST, but the difference, the main difference is that the money that you put as a result of your sale of your property is put or invested in an REIT or rate or right, whatever you want to call it, but it's a real estate investment trust. Okay? You are going to put your property that is selling into the rate, and the rate in turn is going to give you stocks or options or excuse me, the stocks or operating parts, okay, of that property that you exchange. Sometimes they don't like it. They don't like your property. So what do? Well, if you are really want to go into a rate because it's very attractive to you because they told you that is a very profitable one, well, you start to be creative with your team of people. It's okay. I'm going to sell my property as a 1031. Then I'm going to go to a DST that allows a rate, or I'm going to go from 1031 to 721. Interesting, huh? It's not easy. Nobody does that every day, but it's doable. It has been done. Very complex, but you can go and you can do it with your team of experts, okay? Very interesting way to do. And finally, just to change a little bit the gear and finish this webinar with a very nice sweet taste in the mouth, is the icing of the cake that I call, and this is what is called the step-up strategy. What is the step-up strategy? Well, it's a provision. This is everything that I said is legal, right? Careful. In which you can inherit the assets and be very interesting. It can be stocks, bonds, real estate, royalties, mineral rights, wells of oil, etc. when the owner of that dies. Then what happens in the inheritance? If you don't go for the step-up strategy, my friends, guess what? Your son or your daughter or whomever you leave your properties is going to pay the 33% of taxes. But if you go to this step-up strategy, guess what? In the same example of the beginning of the webinar, you bought a 300, right now it's $1 million, you die, your son is not, or daughter is not going to pay the $250,000. Why? Because the statute says that the son or daughter that inherits all that property at $1 million is the basis of acquisition. Therefore, he or she or both are not going to pay 1 penny of taxes. And exactly is the same calculation. The cost basis is the original value for tax purposes, and the market price or sales price is what it was sold. So you just simply make a subtraction. In our example, 1 million minus 300, 700,000, and that is the profit. But your son is not going to pay a penny of the 700,000. This resets, as I mentioned, the cost basis of an inherited asset to its market value on the deceased date of the death. But guess what? You can even go further. If you don't want to make the change at the moment that your dad or mother or grandmother or whatever died, you can hold it up to 6 months and then have an appraise or appraisal. And then that is going to be the new value of the property in which you are going to acquire, or the guys and girls that are going to inherit, and the profit is going to be more, but still you pay zero taxes. Okay, very, very interesting. With that, I think one more time, you need an army of people to make any and all of these exchanges. There are tricks of the trade, as they say. You have to have a professional in each area, whether it's an accountant, title company, the qualified intermediary. Careful there, because your money is going to go to his hands, especially, and awesome commercial realtor. With that in hand, I really, really appreciate all your time. I am here to serve you. This is my information, and I really, really appreciate you being today in this webinar. Thank you.
Thank you. Thank you so much, Luis. This was a great presentation, a lot of good information, a lot of details, a lot of technicalities here. And again, as I told you at the beginning, we all need this information is not readily available out there. So as Luis has been nice enough to put this topic, and it's not an easy topic, it's a lot of legalities. But for business owners, the important piece is to know that there are tools out there, and legal tools that we can save the payment of a tax and defer it to the future, because it's not that you're not paying taxes, it's just that you're deferring the tax to some future time later, right? But these tools are available. It's complicated. It's not easy, as Luis have been trying to explain. But is the point here is to have the knowledge that there are tools available there, and that's what we're trying to do here with Luis and the Latino Chamber of Commerce, and with our members and business owners in the community here in Minnesota, is to provide them with the tools and the knowledge that they can do. Later, you can go and call your lawyer and call your accountant and go into the details, and it's going to be a long process, but you can save some money. So thank you so much, Luis. I don't know if there's any questions from the audience here. If so, yes, there you go. Adriana's got a question, so go ahead, Adriana. We have a few. I have some more time, a few minutes here to address your question. Go ahead, Adriana.
This is a very quick. Luis, do you have any amount of time to own a property in order to have it inside of the 1031 exchange?
That is a very, 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 very good question, Adriana. The 1031 exchange has written in the code that you cannot do flippers. Okay? In other words, you cannot buy a property, fix it, and sell it in 1031 and repeat, etc., every 3 months, every 5 months, You have to have at least, according to what I read, and this can change tomorrow, 6 months to a year. And it has to be not as a flipper, that you are doing this as a way of living, If you do one in your life, that doesn't matter. But if you are doing 3 a year, believe me, the IRS is going to start sending guys and girls to your door, and in the state of Minnesota, more people to get to know you. How do you do that, Adriana? Don't do that often. We don't like it. Another interesting thing, for instance, is imagine that you have a cabin or a house or a Airbnb in Florida. Now that the disaster went to Florida with Milton and Helene, what are you going to do? You lost everything. Well, you go to 1033 exchange, or if it didn't happen anything, that's very important. If that is an investment or business, because if you have a condo or a house in Florida and it's for your enjoyment that you go there for winter time in Minnesota, guess what? That does not qualify. So you have to be very careful which is what and where and how long, you know? If it's a cabin in North Minnesota, no, because you are going there to fish in summer or ice fishing in winter. The Airbnb, for instance, has another, the RBO has another set of rules that says that number one, it has to be for business. Number two, you have to be owner of 1 year. Number three, you have to be there a maximum of 14 days a year. Or you have to be renting it actively for 90% of the year. If you don't comply exactly with these statutes or these statements, believe me, the IRS is going to put a camera there and see when Adriana went and how many days she was there. Seriously, they are very picky and tricky that they can caught you in that kind of thing. My recommendation at what I was searching and reading, if you have an Airbnb, if you have a second house, etc., make sure that is solely for investment. Don't play around with the IRS. Do it straight, right? What did they say? And don't poke the bear. You know, if they say 6 months, go 7 months. If they say 1 year, go year and 3 months. You know, in every case is different, but you have to be very careful with what you have and what you want to accomplish at the end of the day. It's very different. For instance, if you have your house in Florida for business purposes and now it's destroyed, well, you have 2 years to find another one for business purposes. Whereas if you are selling your building here, you have only 45 days and 108 days. You see the difference? So it's very tricky, these kind of things. So in general terms, I'd say 6 to 1 year. But consult to your lawyer. You know?
Thank you, Luis.
Thank you, Luis. Thank you,
Thank you
Adriana,
so much.
for a good question. I think we are done here. If you have anybody that want to participate on our Spanish version of this session next week, please pass the information down. And if you want to do it yourself and listening in Spanish, then you also just connect. Go to our website and check our calendar and register for that session. So with that, thank you so much, Luis. Thank you everybody for participating, and we'll see you next time.
Thank you,
Thank
Fabio.
you very
Thank
much.
you, Luis. Bye-bye.
Thank you, Adriana. I appreciate your presence. Thank you.
Bye.
And to all, of course.